Hello, everybody, and welcome to the first session of our two-part webinar series on choosing your China structure. So the idea behind this series is to help you with some of the most common dilemmas that our clients usually face when they're starting to plan their China business setup. Today's session specifically will hopefully give you clarity as to the advantages and the disadvantages of setting up in Hong Kong versus mainland China, or doing a combination of both locations. My name is Peggyok Hui. I'm Marketing and Communications Executive at Fiducia, and I'm here to introduce you to your speaker for today, Florian Braunsteiner. Florian is a Business Development Manager at Fiducia. He's Austrian, and he's lived and worked for many years in both Hong Kong, where he's currently based, as well as in Shanghai. He happens to love both cities, so there's going to be no bias in that sense. Florian has advised dozens of international clients in the planning and the execution of their corporate setup in China, so he'll be sharing all of that experience with us today. Today's session will be short, approximately 30 minutes, together with a Q&A session included. So throughout the session, you can feel free to write us questions through the question panel, and Florian will address some of them at the end. And we probably won't get to go through all of them, but if we don't, we'll definitely get in touch with you over the next few days to either answer your questions by email or to arrange a call. You can also use the question panel to let us know if you're having any technical difficulties, and hopefully we can help solve them. So that's it from me. Let me hand it over to Florian and let's get started.
Thank you, Pekka, for your kind introduction. And it's a great pleasure to kick off this webinar series now today, comparing Hong Kong and China in a bit more detail. Okay, let's take a look at the agenda for today's seminar. I would expect we will need about 20 minutes to go through the main points, and this will be then followed by a Q&A. So, what are our topics today? So first of all, we would like to explore the location of Hong Kong, its advantages and its limitation. Then we'll look into the question, when or why do I actually need a China company compared to Hong Kong? And then, bring the two together, we want to explore what are the options of a Hong Kong setup and China setup, combining the two, and the various advantages. Okay, before we start, just a few words about our company, Fiducia. Fiducia has been established about 36 years ago here in Hong Kong and in China. So we have spread out into 4 offices: Beijing, Hong Kong, Shanghai and Shenzhen, and we are supporting our clients with 120 professionals spread across those 4 offices. Here now also a short brief look at our services. So we have 2 kinds of services: consulting services and outsourced services. Today's session will be focusing on our outsourced services, or more precisely on our corporate services when it comes to setting up in China and in Hong Kong and how to structure your investment. Okay, so let's start off with Hong Kong. Why would you choose Hong Kong, and what maybe has changed in the meantime? So many times when you hear about China, you might not immediately associate a Hong Kong company with it, but actually it is still a very, very common model to use Hong Kong for your China business, and there's various reasons for that. We just listed here a couple, and I don't want to go into too much detail now, but just simply speaking, Hong Kong has a very straightforward legal and regulatory system, one of the best you can find in Asia, if not worldwide. It's pretty simple to set up your company here in the region. We will see more about this later on. Hong Kong offers kind of preferential tax rates. There is no VAT in place. This can be very important for your trading business. And generally speaking, the topic of taxation and accounting is simpler in Hong Kong than in China. What else to mention here? Hong Kong is obviously a gateway to China and the Asia Pacific region. And here in Hong Kong, we have a number of trading offices, maybe on the purchasing side, maybe on the selling side. Most of the Fortune 500 companies have an office here for this purpose. And well, last but not least, Hong Kong is also known to be a very compliant economy with a low risk of corruption and fraud. Okay, so looking at some of the key factors comparing Hong Kong and China. As you can see from this table here, Hong Kong has some key advantages compared to China in terms of several factors. For example, the setup time in Hong Kong is considerably shorter than in China. It may take you up to a few weeks, in theory even less. However, we need to help you to structure your investment and to arrange the various documents with the authorities. On the other hand, in China, it may take you up to 6 months. This is up to the various authorities you're dealing with in the cities in China. This may vary, for instance, from Beijing to Shanghai. Then, what's next? The capital requirements are also very different. The reason is that Hong Kong has free flow of capital as opposed to China, where China applies capital controls. For this reason, the investment is much larger than it is in Hong Kong. But also tax rates are beneficial in Hong Kong, as you can see from the slides. If you have questions towards those tax rates and especially maybe also the capital requirements that are required in China, we can answer those in more details during the Q&A. So now we talked about the advantages of Hong Kong. However, there's also a couple of drawbacks. Most notably, your costs, your daily operation costs, will most likely be higher in Hong Kong than in China. One example would be rental. Rents in Hong Kong are among the highest, if not the most expensive rents in the world, depending where you set up your office. But if you want to set up shop in the central district in Hong Kong, you can see here that this is even more expensive than New York Midtown. However, also Beijing, Shenzhen or Shanghai have also considerably caught up on rental costs in the past couple of years, so this factor is diminishing. And also salaries are another cost factor that at the moment is still more expensive in Hong Kong than in China, however also depending on the location. So here big cities in China such as Shanghai, Beijing or Shenzhen are slowly but surely catching up. If you would like to learn more about the salary structures in both locations and also in terms of taxation, feel free to raise more questions during the Q&A session. And if you're actually looking for people to hire in China, this is also something that we can support you with. So, coming now into the next session of our webinar. When do you actually need an entity in China? This is one of the most frequent questions we are dealing with our clients in our daily interactions. So here now a summary of reasons why you need to set up an entity in China, and also in these cases a Hong Kong entity would not be enough. So first and probably most common reason is that your company in China needs to issue local fapiaos, that's the Chinese invoice including the VAT. Second reason might be that you want to hire people in China directly, and this again is only possible if you have your own legal entity in China. So hiring employees, this can both be done by a representative office or a WFOE, which again stands short for Wholly Foreign Owned Enterprise. And my colleague Laura will tell you more about this during our next session. Also, if you wanted to open a corporate bank account in China, yet again, you will need your own company here. So looking a bit more now into operations, say you are a retailer and you want to open a store in China, then you would need to first rent a physical office store and enter into a rental contract. So as you can see here, this again is only possible if you have a physical entity in China. And as you're probably aware, the retail space in China is very heavily driven by e-commerce. If you were to acquire a local e-commerce license, then you would need to have a WUFI, so a wholly foreign owned enterprise, established here in China, and it also would have to be established for a certain amount of time before you can even apply for such an e-commerce license. Or to be more precise, you need to be set up in China for minimum 1 to 2 years before you can work together with Tmall or Alibaba in setting up your own store. However, if you wanted to set up a cross-border e-commerce store, this would not be a requirement. So after now having seen a couple of reasons why it makes sense to either set up in China or in Hong Kong, let's explore now when it actually makes sense to combine the two. It's still a very frequent model for our clients that Hong Kong is being used as the regional headquarters for your China business and for your Asia business. This has several key advantages and several reasons why companies consider to do so. So first of all, it might be legal reasons. Hong Kong has a superb legal system in comparison to other countries in Asia or even worldwide. It is based on British common law, and the court language is not just Chinese or Cantonese, but also English. What is more, many of your Chinese clients or suppliers, they might be even used to or they might be more open to the idea to have legal disputes to be fought in Hong Kong. So besides a mere holding function, Hong Kong also has oftentimes a function as the regional headquarters in terms of sales and distribution or in terms of sourcing. So what might be the reasons for that? So we just covered a couple of the legal reasons. However, there's also some others. For instance, the tax perspective. Hong Kong has no VAT, which makes it, well, easier in terms of administration and also easier when selling to the end customer, since the VAT is not being charged to him. Moreover, tax rates are also favorable. Comparing to China, for instance, Hong Kong has a tax rate of 16.5%, as we saw already a couple of slides earlier, for corporate income tax or profits tax, as it's being called here in Hong Kong, and the corporate income tax is 25% in China. Moreover, dividends are tax-free in Hong Kong. So when you take out money of your Hong Kong company, there will be no more taxes applied in this case. There's also another important tax consideration to mention, which is when you bring out profits out of China into, let's say, the United States or maybe some country in Europe, then there will be a withholding tax applying. China's standard withholding tax rate on dividend transferred back to your home country can vary quite significantly. So under normal circumstances, we're talking about 10%. However, depending where your headquarters is from, in which country of origin is located, this can vary. So for Germany, for instance, there's a double tax agreement in place of Germany and of China, which means that your withholding tax rate is only 5%. However, if you were to transfer profits back to other jurisdictions, let's take for instance the United States, you would have 10%. And another example would be even of Australia, where the withholding tax rate is 15%. So how can you circumvent maybe this higher tax rate? One example here, you could use a Hong Kong company in between for the withholding tax rate. So the withholding tax rate of Hong Kong and China is only 5%. So if you were to have a Hong Kong company in between your headquarters in Australia or United States in this case, you could benefit from this 5% withholding tax rate. And now remember what I said earlier, there is no tax on dividends in Hong Kong, which also means when you transfer dividends from Hong Kong into another country, no extra additional tax will apply. But now also, independently of withholding tax rates varying across various jurisdictions, it's also worth noting that bringing money out of China is possible, so you can do that. However, it's quite a painstaking administrative procedure and might take up to a couple of months. However, of course, you need to argue your tax case with the tax authorities, so it's important to have the right kind of setup here. This is where we can advise, the right kind of tax consulting, but also you need to provide some kind of substance to authorities. So if you have more questions to that, I'm happy to answer them later on. So in the following 2 slides, we're going to explore a little bit more in detail what we mean by a sales and distribution or a sourcing hub in Hong Kong. So if you have a look at this slide here, you see that we have 2 dimensions basically. The one is the level of engagement you have with China, and the other is where located geographically speaking. So now we put here the European flag, we could have also put the US flag, and it doesn't really matter in this regards. So what we show here is 3 different ways of selling products into China. The first one, and this is probably the most straightforward way, and is actually not clear on the slide, but I want to add it, is that you actually just sell your product via distributor or to your final customer from your home country. So there's no companies in between that you need, and that's obviously the first case. However, if you want to involve a Hong Kong company or a China company, then you basically do have 3 ways how to do that. The first one is that you sell your product from the States, from Australia, or from Europe via a Hong Kong company to a distributor. This is a frequent case in many industries. I could point out, for instance, medical equipment. Here, for several reasons, often compliance reasons, but also because distributors in general, and especially in the medtech field, are used to this solution, distributors would be invoiced in Hong Kong. So this way you can circumnavigate any kind of currency issues you might face in China, any kind of cap control issues you have in China, and there is an additional layer of administration, but also maybe compliance in Hong Kong between you and your distributors. However, it can also make, of course, sense to have both a Hong Kong and China company. We mentioned a few situations already, but let's stay with this medical equipment case that I just gave. Let's say you are selling predominantly via Hong Kong into the Chinese market with distributors. At the same time, there's a number of direct customers in China that need to be invoiced in renminbi, that need to be invoiced with a fapiao, so with the VAT. In this case, you can also use the China Wufi, so you're selling with both companies, both in Hong Kong as well as in China, and you're more flexible. And at the same time, this can be useful for other reasons. Let's say that you're selling via Hong Kong, but in China you need to employ people for other reasons. May it be for business development, may it be for some sourcing, may it be for QC or engineers, sales engineers. This is another reason why you want to have a combined option of the 2. And then the third option you see here is a bit of a special case of option 2. This just means that you also have distributors in China that you invoice via your China entity. There are certain cases where this can make sense, but I would say the most important cases are number 1 and number 2. So now we're talking about sourcing in China via Hong Kong as a combination. This is still a very, very frequent and common case, and I would even argue that while the trend has been in the last decade that more sourcing functions are being moved from Hong Kong to China, there is a little bit of a reverse happening these days for several reasons, and one of them being that the pricing gap between Hong Kong and China in terms of rents and salary is closing. So China is really catching up with Hong Kong, and then the advantages we mentioned of Hong Kong, for instance in terms of administration, they get more interesting again. And at the same time, a lot of sourcing has been moving these days from China into other countries in Asia. Let's take, for instance, shoe industry. A lot of shoe manufacturers have moved from China to Vietnam. So in this case, again, you can use Hong Kong as a consolidating company and as the purchasing hub in Asia. So we are working with a large number of clients that have exactly this kind of model in place. They have as you can see here, reading maybe from right to left, they have a supplier in China. They need to QC with this supplier, they need to do some product development with this supplier, but the actual purchasing is then done in Hong Kong. So the product is purchased and then shipped via Hong Kong into United States, Australia, Europe, or I don't know, South America, depends where your clients are based. And the order processing, the invoicing, the sales transaction, this is happening in Hong Kong. So we can support you on this end, not just with the setup, but we can also support you with the bookkeeping and even with the logistics operations behind such a purchasing or also behind such a sales company. And one more point potentially worth mentioning here is we are supporting our clients with our own ERP system. So this can be a quite interesting solution if you are very system-based or system-driven, and gives you another layer of control towards your entities in Asia. So summing up now, how can we help? So I think we touched base on a number of topics. Basically, we can help you with the registration of companies in both jurisdictions, both in Hong Kong and in China, and we can help you with taking care of everything that follows the registration. So may this be opening of bank accounts, may this be employment contracts, changes of your shareholder structure, appointment of directors, and so forth. This can be handled by us. And at the same time, as I indicated last slide, we are also happy to help with topics such as finance, accounting, tax, and trade logistics.
So thank you, Florian, for your insights. I hope that you all have now a clearer idea of the advantages and also the limitations of a Hong Kong entity and how you can combine a Hong Kong company with a China entity and in which scenarios this makes sense. Now we're going to go on to a Q&A session. So we're going to be answering some of the questions we have received. We might not get to answer all of them, but we do promise to get back to you via email or phone after the webinar over the next week to do so.
Yeah, that's exactly right, Pika. I've seen a lot of questions now that have been sent to us via the chat function and also up front. So I think we will now just try to answer 3 of them, which are selected because they're seeming very relevant to me. 1 related to Hong Kong and 2 related to China. And the other questions, again, we're happy to follow up via an email and get back to you, set up a call, and discuss these questions. So Peter here has been asking about the ever-increasing scrutiny of the Hong Kong tax authorities in terms of transfer pricing. I think that is a very good question, and I can confirm that. So we have now entered an environment in China and Hong Kong where tax scrutiny has definitely increased, and this has translated into more inquiries here in Hong Kong from the IRD. So what's the IRD? This is the Internal Revenue Department of Hong Kong. Typically, they want to know about your transfer pricing arrangements and about your business activity. So these are the 2 questions we are dealing most frequently with. Oftentimes, they also would start inquiring if you are declaring that you have an offshore business in Hong Kong. We are not so much involved into these kind of offshore businesses these days, also because the scrutiny has really been increasing. Overall, I think it can be said that the procedures of the Hong Kong IRD are relatively transparent and good to understand. However, I would really advise, once you get an inquiry from IRD, you should best seek a professional's advice in order to avoid any kind of mistakes here. So the next question here comes from Anna. She is asking about the differences of functions in a China company and in a Hong Kong company in terms of legal rep. So one clarification here, Anna. The legal rep only exists in China, not in Hong Kong. In Hong Kong, we have a different function. It's called the director. And indeed, there is a big difference between a legal rep in China and a director in Hong Kong. So, for instance, and this is actually translated into a bigger picture of difference between the two jurisdictions. So Hong Kong has a much more employer-friendly labor law environment, and this is also the reason that changing directors of a company or even letting go of employees in general or hiring new employees is just less strictly regulated and easier for employers than it would be in China. This comes to such an extreme sometimes in China that it is very hard to let go of a legal representative. So legal representative, this is the highest function in China, and the legal representative has a great deal of power in China, and hence need to be selected carefully because it's not easy to let go of your legal representative in China. I would say that this question, if you have more requirement to be answered in depth here, I would suggest you join our next seminar, which will talk about this more in detail. So now I see here another question by Roger, who is saying that he's engaged in a sourcing business. He's operating out of the United States, and he's saying that currently, Roger, it says you are employing your employees in China via a consulting contract. So you just pay them on a monthly basis out of the States. And so you're worrying or asking, is it really necessary for such a small business to set up a China company? This is a very good question, and this is one of the most frequently asked questions we deal with. So basically, you are required by law to set up a company in China once, or be more precise, to hire a company in China to hire employees there once they are working for you for a longer term basis than 6 months. So if you don't do so, you automatically by law establish something called a permanent establishment, which is basically the same like a China company, just with potentially a few disadvantages. So our compliant advice would be, if you have employees in China that are working for you more than 6 months per year in China, then yes, you should set up a company in China and pay these people via your China company. And to be clear again, you could not employ them via Hong Kong. So as I said in an earlier slide, if you have people based in China, they cannot be employed via Hong Kong. This would be basically, legally speaking, the same as employing them from the United States, because they're two different jurisdictions. Yeah, so we're already a little bit short on time here. Once again, thank you for the many participants that took part in today's seminar. I think we're about 50 people. That's great to see. And I would encourage you that if you have any kind of questions we couldn't answer today, and I saw that some of you couldn't get their questions answered, please feel free to drop us an email. We're happy to set up a call with you and go through your questions. So Pekka, will hand back to you now, and thank you for setting up this webinar.
Thank you, Florian, and everyone else for taking part in today's webinar. Just as a reminder, in 1 week on November 8th, at this same time, we're going to have the second part of this webinar series, where our colleague Laura Velasco, who is our Shanghai-based client services manager, will be talking about the different investment vehicles for your China investment, and more specifically, whether you should set up a wholly foreign-owned enterprise or a representative office. So for those of you who haven't registered for the second part of our series, you can do so by scanning the QR code, which is on screen now. And Other than that, I would just say thank you once again. And if you want to stay in touch with us and follow our very frequent publications and China Insights, you can subscribe to our newsletter, follow us on LinkedIn, and also visit the Insights Library in our Fiducia website. The address is on screen now. And anytime, please feel free to contact us at the email shown on screen.
And we'll be happy to set up a call or answer your questions via email. So that's it, everyone. Thank you very much, and hopefully see you next week. Have a nice day.